Welcome to Iron Financial, the show where we forge stronger portfolios by putting companies to the ultimate test. And today we are putting Paychex directly on the anvil. They just posted what on the surface looks like an absolute knockout quarter, but the stock is getting hammered. I mean, truly hammered. Now that's a red flag we just can't ignore. It's a signal of a deep, deep conflict in the market. Our mission here is simple. We're going to hammer away at the weak points and find out if this is a solid steel investment ready to be molded into profit, or if it's just a brittle facade that's about to crack under the slightest pressure. All right, let's get to work.
So let's get right into the heart of the matter. This is the central paradox we're wrestling with today. On one hand, you've got the hard facts. Paychex just delivered a monster of a quarter, beating Wall Street's expectations on both the top and bottom lines. I mean, it was a textbook display of strength. But then, on the other hand, you have the market's brutal reaction. The stock has been absolutely crushed, down over 20% in just 3 short months. Now, this is exactly the kind of disconnect we live for here at Iron Financial. It means one of two things. Either it's a glaring market mistake, which spells a massive buying opportunity for those of us who can see clearly, or it's a terrifying sign of a deep, hidden weakness that the headline numbers are trying to cover up. So, which one is it? Let's find out.
All right, let's start by forging the bull case. We're not going to talk about feelings. We're not going to talk about sentiment. We are starting with the raw steel, the hard, cold numbers from their latest Q3 report. This is all about pure, unadulterated performance. Now, as we walk through these next few slides, I really want you to see the undeniable facts that make this recent stock drop look completely, and you know what, maybe even profitably irrational. This is the foundation of the entire bull argument. Pay attention. Okay, let's start at the top, with the top line, the lifeblood of any company. $1.81 billion in total revenue for the quarter. Now, you have to understand, this isn't just a beat, it's a decisive blow to the bears. Wall Street was modeling they were expecting $1.78 billion. When a company smashes expectations like this by $30 million, it tells you that the core engine is running white hot. You know, this isn't some rounding error. It's a clear and powerful signal that demand for their services is incredibly strong. And here is the real power play. Just look at that growth rate, 20% year over year. I mean, come on. In today's choppy economic environment, a 20% growth rate is not just good, it is absolutely exceptional. But here's the key detail you can't miss. This isn't just some slow and steady organic growth. The company explicitly stated that the Paycor acquisition acted like a rocket booster, accounting for a massive 19 percentage points of that growth. This is a company that's on the offensive, aggressively seizing market share and scaling up at a pace that its competitors can only dream of. This is a pure growth story, plain and simple. Look, revenue is great, but profit is what forges real, tangible shareholder value. And on that front, Paychex delivered $1.71 in adjusted earnings per share. And once again, they absolutely crushed the consensus analyst estimate of $1.67. This right here is the critical proof point. It proves they're not just getting bigger, they are getting more profitable. Even while they're doing all the heavy lifting of integrating that massive Paycor acquisition, they're turning that new revenue into pure profit with what I can only call ruthless efficiency. That kind of discipline is exactly what you want to see as an investor. Now let's break it down by segment because this company is not a one-trick pony. The strength here is broad and it's deep. Management Solutions, which is their core business, their main engine, is up a massive 23%, just supercharged by Paycor. But look deeper. PEO and insurance, which is a more mature segment, is still posting a rock-solid 9% growth. And then you have interest on client funds up a staggering 33%, all thanks to higher balances from the acquisition. Every single cylinder is firing in perfect sync. This is a company that's leveraging its new scale with precision and with power across the entire business. And, you know, strong numbers like these always come from strong, confident leadership. These words right here from CEO John Gibson, they're not just corporate speak you find in an annual report. This is a battle plan. He is making it crystal clear that the company's future is in dominating the AI-driven digital world of human capital management. He's telling you, he's telling us, the Paycor acquisition wasn't just about adding revenue, it was the key strategic move to secure technological dominance for the next decade. This is not a company that's playing defense. This is a company that is forging a technological dynasty. And finally, the ultimate sign of financial strength and management confidence, cash returned directly to the owners, to the shareholders. $1.5 billion returned so far this year through a combination of dividends and share buybacks. And they're not stopping. They just announced a new massive $1 billion repurchase authorization. On top of all that, you have a 4.77% dividend yield. Let me be perfectly clear. Weak, uncertain companies, they hoard cash. Strong, confident companies reward their owners. Paychex is a fortress of a company, and the bull case is built on a foundation of pure, hard cash.
Hold on. Whoa, hold on a second. That's a slick presentation, I'll give you that. It's very polished, but the market isn't buying it, and I think it's for a good reason. You've shown us this shiny, perfect exterior, but I'm here to grab a hammer and start looking for the cracks in that foundation. Because when a company looks this good on the surface, but the stock is absolutely tanking, it usually means there's something rotten underneath that the pretty numbers are trying to hide. So let's see if this solid foundation of yours can actually withstand a real stress test. Okay, let's go straight to the engine room. Profitability. Our friend the analyst loves to talk about that adjusted EPS number. But let's talk about what adjusted really means, shall we? It's where companies hide all the messy stuff, the one-time acquisition costs, the integration expenses that they really want you to ignore. So let's forget the adjusted numbers for just a second and look at the real GAAP operating margin. It's down. It went from 41.2% down to 39.6%. That's not a small detail. That's a huge red flag. It means the cost of doing business is going up, profitability is being squeezed, and that, my friend, is the first sign of a very serious crack in the armor. And here's exactly why their real margins are getting squeezed. Costs, they're spiraling. PEO insurance costs are up 10%. Other expenses are up 9%. But the real poison killing the profitability is the Paycor deal itself. Just look at these two lines. Interest expense exploded by over $68 million because of the new debt they had to take on. And on top of that, a whopping $162 million in direct acquisition-related costs. This isn't the cost of growth. This is a boat anchor tied directly to their bottom line. The bulls love to celebrate the revenue from Paycor, but they conveniently forget about the mountain of costs that came along with it. And hey, don't just take my word for it. The pros on Wall Street, the ones who analyze these companies for a living, they are sounding the alarm. Cantor Fitzgerald isn't just neutral. They have an active sell rating on the stock. You've got big banks like Royal Bank of Canada and BMO Capital Markets, and they aren't raising their targets. They are slashing them. The professional consensus here is clear: reduce. This isn't just market noise. It's a deafening chorus of skepticism from the people who know this company best. And when the smart money is quietly heading for the exits, you had better pay very close attention. You know what? You're right. You've laid out the bear case perfectly, and every single point you've made, the margin pressure, the rising costs, the Wall Street skepticism, it all leads back to one single massive event: the Paycor acquisition. This is the absolute pivot point for this entire company. This is the single biggest bet in Paychex's history, and it will either forge their future into something stronger or it will shatter it completely. So let's stop talking in hypotheticals. Let's put this deal to a real stress test and see if it was a brilliant strategic move or a catastrophic, company-altering blunder. Before we go any further, let that number really sink in for a moment. $4.1 billion. That's a massive number. This wasn't some small bolt-on acquisition. This was a bet the company move, plain and simple. Exactly. The stakes here are absolutely astronomical. When you bet this big, you'd better be damn sure you're going to win. The question for every single investor looking at this stock today is, did Paychex make a winning bet, or did they just sign their own death warrant? And this slide right here shows you exactly why they took that enormous risk. This was a strategic masterstroke, not some reckless gamble. In one single move, the Paycor deal was a quantum leap for the company. It launched them upmarket into larger, more profitable client segments. It instantly upgraded their technology to make them a leader in AI. And most importantly, it gave them a massive new customer base to cross-sell their most profitable services into. Management is already confirming they're on track to exceed their synergy targets, and new business bookings are already back to pre-acquisition levels. This isn't just a good plan, it's a blueprint for total market domination. A masterstroke that cost them $4.2 billion in new debt. They went from a clean, fortress-like balance sheet to being shackled to a mountain of debt that is going to be a dead weight on their earnings for years and years to come. That debt comes with interest payments that eat into profit every single quarter. For every dollar of new revenue the analyst is so excited about, there's a dollar of new debt weighing this entire company down. That's not a masterstroke. That is a deal with the devil. So here it is, the billion-dollar question that this entire analysis boils down to. Is the Paycor deal a brilliant strategic leap forward, a necessary expansion to conquer an AI-driven future? Or is it a reckless, debt-fueled gamble that has permanently crippled the company's best-in-class profitability and its financial health? The answer to that single question will determine whether this stock is the bargain of a lifetime or just a classic value trap. And that's the decision you have to make. Okay, we've laid out the evidence, we've hammered on it from both sides. You have the bull case of strong, undeniable growth right up against the bear case of crushing new debt. Now it's time for the final verdict. To get there, we're going to look at two final, absolutely critical pieces of evidence: the stock's current valuation and the company's own official forecast for the future. This is where the rubber meets the road. Okay, first, just look at the valuation. The stock is trading near 5-year lows on almost every single key metric you can think of: price to earnings, price to sales, price to book. It is cheap relative to its own history. Independent models like the one from Guru Focus put its intrinsic value at over $150 a share. From where it's trading today, the bulls see a massive, undeniable bargain. But the bears, they see a trap. They're asking the hard question: is it cheap or is it a falling knife? A low valuation is absolutely no comfort when the fundamentals are crumbling underneath you. This could be a classic value trap, and investors who fall for it because it looks cheap are the ones who are going to get burned. So what does management say about those supposedly crumbling fundamentals? They say the bears are dead wrong. This is their official forecast for the full fiscal year. They are guiding for 16.5% to 18.5% total revenue growth. Their main engine, Management Solutions, is expected to grow an astonishing 20 to 22%. This is not a company that's worried. This is a company projecting incredible strength. For all the talk of margin pressure and debt, management is putting their reputation on the line and promising a massive year. That's a direct challenge to every single bear on Wall Street. So here we are, right back where we started: forged steel or fool's gold. Do you bet on the incredible top-line growth, the confident management team that's putting their name on the line, and what looks like a rock-bottom valuation relative to its history? Or do you listen to the warnings from Wall Street, the clear evidence of margin pressure, and the crushing weight of their new multi-billion-dollar debt load? The fate of this company, and maybe your portfolio, hangs on that one single question: was the Paycor deal a stroke of genius or a fatal mistake? The market is pricing this company for a world of pain. Management is promising a home run. The truth is probably somewhere in the middle, but the real question for you is whether today's price gives you a wide enough margin of safety to stomach that risk. The market has made its bet. Now you have to make yours.
Quick disclaimer: everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.